Hi everybody, this is Gary Dean and this is our weekend video report for Sunday, January 24th, 2016. I am going to be hurting tomorrow morning. I just got done shoveling everything, and for the love of Pete, I swear at some points there was 4 feet of snow I was digging out of, so it was not fun. But anyway, let's get started. Had a pretty good rally on Friday. It was expected. It was coming a little, strangely. But the SSO trade that I was in, where I closed half of it, and I'll show you why. It was more on the shorter term charts for my reasoning. But it made 1,300. It was up 1,300 when I closed half. So bare minimum is locking in 650 if for some reason we get stopped out. But if I just think that the option wise, like I said, if you're not perfect with the time part, even if you're right with the direction, you can still lose money, and that's what was making things really hard to manage those. So let's do a quick recap. This was a pretty fierce drop. I don't think it's over. I think this is a bounce, but I do believe the bounce could go a little bit higher than what people are expecting. Like I said, somewhere up to the 1951 would make sense. But once we complete that, most likely we're going to come back down, and I wouldn't be surprised to see the S&P trading, someplace at this between the 1770 all the way down to the 1740, and that is probably going to be the better buying opportunity. Where from that point we then get a more, say, extended type move higher. And then I would leave the door open that we could get a bounce all the way up to the 2040, which would be closing the gap here. And right now, I believe we're in something like this type of move up, and then we're going to come back down. But I do believe these lows will be taken out because this was just a different time period. But where we say bounced made sense because there was support here. So it was a nice bounce. It needs to get through. Say it's trying to poke through right now, but this is really just the next resistance, and if it breaks above it, then we should have a pretty clear run someplace up into the 1951, and if it gets through that, then we're probably looking at a move coming up to the 1975 and possibly 1990. Now, I'm not 100% sure it gets there, but these are just daily resistance that we want to keep an eye on. You can see we're just starting to turn up, but we don't have any bullish divergences. That's why I believe we're in something like this, and then we're going to come back down. But even though this time, we didn't take the lows out to form any bullish divergences, I do believe this one will. And for the main reason, I just believe that the market has changed, and rallies are going to be sold into. So if we look at a daily chart, still have some room to go before we're into the overbought levels. Like I mentioned, it doesn't really make a difference how the wave structure is, but you see 5 waves down, and we know that because of the bullish divergences here. So a typical retracement, like I said, will be anywhere between the 50 and the 62% retracement, which is between the 1947 and the 1977 level. So that means that we could extend for a couple more days, but there's reasons to believe that we are going to get a quick pullback first before we try higher. Now, we're above the first moving average. Typically, they'll try to go to the second one. That's going all the way up to the 1986, which still fits the bearish pattern because, like I said, a typical retracement after 5 waves is anywhere from 50, 62, all the way up to 78% retracement, which is 2024. So you can see like anywhere between this the 1980 and the 1986 level, that's a 62% retracement as well as the moving average, and it's an area that wouldn't surprise me to see if it gets tested or not. But again, the first really resistance that you want to keep an eye on, there's a gap that's at the 1919, so a good chance we're going to come up here and close this gap. If the bulls can push above that, then that's where it would leave the door open for a move to the 19 I believe this was 1936 to the 1947. So the first area that the bulls have to push through really is going to be this 1913 to 1919. If they get through that, then we could look for the 1946, 46, 47 level. And if they push above that, that's when you start looking for the 1978 all the way up to the 1950 or 60 area. So it's probably easier just managing things like this, saying, okay, this is, the resistance area. If they break through, then this is the next spot. If they break through this, then this is the next spot. So we'll know on Monday what the, what the market has in line, because if we see a pullback, then it's probably going to be, this is your A, B, and then the wave C will come someplace up to these levels here. So we're running into the first, resistance area. If they push through, then just keep an eye on that 1927 and then the 47 level. So on a 15-minute chart here, if we get some type of pullback, you can see this is the heavy support area, and that's right around the 1888. So it would give us a little time to burn off some of the oversold levels on the short-term charts. It's support. We have moving averages that are combining right there. So again, this is going to be pretty important for the bulls to try to hold if they are going to try to push hold higher without a any kind of sustained pullback. If they lose this, that leaves the door open for a move to come all the way down to the 1860. So I'm expecting that we are going to get some kind of pullback. If maybe they try up for the 1918, which is the open gap right there, or again up to the 1934. So they could head up here first before the pullback. But right now we have bearish divergences on the 15-minute chart. We're very overbought. And it would make sense if we do get some kind of little pullback here and then head back up again. So just looking at a 5-minute with just fib support, you can see that, again, at this 1890, 1886 level, it's going to be pretty important for the bulls to hold. If they lose that, then again, we have this open gap that's at the 1876. And then the 38% retracement at the 1872. But even on a 5-minute chart, you can see that we have some bearish divergences as well. So the short-term charts are saying to leave the door open for some kind of pullback tomorrow. Being that we've, the longer-term charts like the daily and the 60-minute are pretty oversold, that means that it's not a certain thing that we are going to get any type of pullback. It would just make sense from the shorter term charts. But I do believe that we have another push higher coming. Like I said, anywhere from the 1934 to the 1945 area would make perfect sense. If it gets there, I probably wouldn't mind moving to cash and just waiting for things to turn and show some bearish divergences, and then switch over to the SDS end, which is the short for the spiders. So with that, let's see what plays out tomorrow. One quick thing is I'm doing a webinar tomorrow at 9 a.m. I'm going to be attaching the link, whether you guys can make it or not. A lot of it is the same stuff that I go over. That if you've been to any of the webinars, it's not going to be any different. But if you can just register, it really tracks just our, the people that register for email, so we can do these things again. So if you guys can click on the link and register, it would be greatly appreciated. And with that, enjoy the rest of your weekend, and I'll talk to you guys in the morning.